So we've seen a weak open to Asian shares. So we're looking at why they're actually collapsing. And then we're going to have a peek into the US. Is the fate of US equities sealed now in terms of bearishness? And then for our trading takeout, we're going to focus on why you have to understand whether the trade you're taking is momentum based or whether it's a mean reversion trade. So we can see that the Hang Seng is down about 1.77% on the front part of the week. And this is due to more jitters in the Chinese property market. If we were to look at Evergrande, for example, we can see that they have also collapsed a little bit further on the front part of the week. So they're down a good 14% today. So the Asian property issues are really, really driving things again. And it's not great news either in terms of Japan, because UAIDA has just come out and said that they're going to keep easy policy for the time being in Japan. So that's also causing some jitters in that. You have to ask the question, why do they want to keep easy policy? Is it because there's some recession fears? Is it because they think that there's going to be a real big collapse in inflation, leading to a more disinflationary or deflationary regime again for Japan? So there's these concerns at the moment that we're in a sort of regime shift. And this is the kind of messaging that is causing problems throughout economies. I think we're going to move on to the US in a second, but certainly through Asia, there's issues stemming from China, from that property issue that they're really, really experiencing. And UAIDA actually in the last couple of minutes, has just said he's added to his comments with regards to continuing monetary easing. And he's saying that they need to closely watch currency market moves, and they're not in a situation where achievement is in sight of 2% inflation. So there's concerns over in Japan of how the economy is going. Currently, Japan's inflation is running slightly above that, but they don't think that it's going to be sustained for the long term effectively. So yeah, jitters going on in Asia. And if we look at the dollar then, so if we look at dollar yen, we can see how the market's reacting. It's off ever so slightly, but it did just breach a high, which I think is the high from November last year, is approaching the high from November last year. So there's a key level up there at 152 that just keeps getting pushed up against. You can see this grind up. And the problem with grinds up is they tend to be the dangerous moves. The moves where, say, there's a 400-point rally here up into 152, that's not concerning. The concern will be is if we just keep grinding up into December. Because as you can see here, what happens when you get a really, really fast shift up, which is what happened in October, is you get a quick reversion. Whereas the market actually feels like when the market's grinding up, it feels as if there is a sort of acceptance of these higher prices. Whereas when it comes to just shifting up, there's not. There's many people that say, okay, that's gone too far now, let's sell it. Whereas if it's just ticking up and up and up, 20, 30 basis points a day, the market is saying, okay, we're content with that. There's no issues. So the danger in markets is a grind up. The danger in markets is never a fast shift up because they're acted upon quickly. So that is where we should be concerned with yen weakness, in my view. So moving on to US equities, it feels like the comments that Powell made last week after the FOMC are still causing some jitters, in my view. In terms of what was said, he said that soft landing is not their base case. So what did he mean? He's effectively saying that he thinks there's going to be a recession. Well, at least that's how the market's taking it, because it's just not very happy with Powell at all. Whether he meant that or not, I'd have expected it to have been walked back by now if it was not intended, but it hasn't been. So we've kind of got to go with the line that that is what he intended. Now, the key feature here is employment. Employment is still very strong in the US, and that tends to be the last factor that goes, the last factor that indicates that a recession is on the horizon. But the market seems like it's pricing in a recession now already. But the problem is that it's also pricing in interest rates to stay high for longer. So it's in this conundrum where it's just shifted to being like, okay, well, he's saying that he thinks there's going to be a recession, but we've also got interest rates at high levels that are priced in to remain at high levels. Now, where is the variable going to come in that might be a boost for equities over the next 9 to 12 months? And that is whether it starts pricing in rates to be cut in the shorter term. But let's forget 9 to 12 months out. That's not necessarily, important. If we're looking at the S&P 500, I've got the futures in front of me here. This is really the short-term defined range. So we've got 4,400 and 3,455. Below 3,455, it feels like there should be bearish impetus pushing into the market. And above, it's probably a reclaim. If you want to be kind of more certain, there's probably the reclaim of 44.14 pushing up to 44.33 as an intra-week. However, this is really the key one. If we see the market start to falter here, and it makes sense to, given that the euro is equally as bearish. So let me just add euro dollar here. Euro dollar could push through this low in the same way that the ES could push through this low. So if the euro starts ticking down towards, say, 106.50 ish, sorry, not 106.50. If the euro starts ticking down towards 106, it should give that, idea that, this level on the ES is gone, and we should start expecting lower prices, maybe down to 42.66, which is unbelievable to think of, really. But it looks like that's where the trend is headed since August. You can see here, late July even. You can see here that this is where the sort of trend really changed for the ES, and that looks like where we're headed. We are headed lower on US equities, but, and it's a big but, if we do start getting good data in terms of employment, the revised figure is 16% lower throughout 2023 of jobs added in the US, then that should be a nice booster in terms of a Goldilocks. The market will accept that those higher rates are okay. It will disregard Powell's comments about the soft landing, in my view, but I'm still skewed towards Powell's comments being the cement here, the cement that is holding the direction of US equities together for the foreseeable. So, yes, in my view, bearish, shorter term, 43.55 is a key level to be focused on SPX, CFDs, or the ES if you're trading the future. Today's trade and takeout is to understand whether you're taking a mean reversion trade or whether you're taking a momentum trade. And it's key to get this, really, because the market behaves in these two ways in many different frequencies over a time period. And that means that most of the time, the market is actually mean reverting. There's a smaller percent of the time where the market is actually, taking a momentum-based approach. And this tends to happen during a regime change or a trend change. The market's not trending most of the time. Most of the time what we're doing is we're kind of going sideways, looking at different ranges, which is why I've expressed an interest when I'm talking about the ES trade or the S&P 500 trade, to really focus on, whether we're breaking that level or whether we're going to remain within that range. Now, there's another factor to this which introduces market mechanics, and it's that take profit levels tend to be sticky. So take profit levels tend to cause price to stick around a level, which introduces the concept of, those pin bars and reversion. Whereas, levels where there's a lot of stop losses tend to cause a cascade and tend to cause this momentum effect. So understanding whether people are taking profit at certain levels or whether they're getting taken out of the market is absolutely key. Now, when you then introduce the concept of, data points, event-driven trading, that kind of thing, you tend to then be able to gauge whether people are getting absolutely shafted or taken out at certain levels, or whether they are, seeing a reversion in the ideas, and whether they're actually taking profit, whether they're accepting that this level is a place where, they're like, okay, let me actually take my money out of the market now, or whether, they're losing money and they're going to get absolutely railroaded through.